Kenya manufacturing, that's what we're doing right here. Over 100 manufacturers right around, so you can go and sample what they have. Factory prices, by the way, for those who are joining it via live stream. So it's one thing to be part of it live stream, it's another to go around and pick your product at a factory price. So you can come on down and do that at Kasarani. The hashtag is Tupatane Kasarani. You can also use the hashtag Changamka Fest as we get into that conversation online. In studio, in this point in time, what we're talking about right now is all about manufacturing and taxation. Go hand in hand, but how can you make that relationship more symbiotic as it moves forward? That's what we'll be exploring this morning. We have a very able panel to go through that particular discussion. But before that, I would like to call on stage the Commissioner, Domestic Taxes of the Kenya Revenue Authority, Rispa Simiyu. Rispa, please come on stage. Asante.
Good morning, everyone, and thank you for the opportunity. My name is Mrs. Rispa Simiyu, Commissioner Domestic Taxes. Saying hello to everyone here and online, all protocols observed. Mine is really brief. I'm here to represent my Commissioner General, who could not make it to be here with us today. But I'm indeed pleased to be here with you to just participate in this whole conversation. As they say, there are two things that are sure in life: death and taxes. What we are aware of is that as it is, I am not sure how many people like to pay taxes. Maybe from this crowd I can see by a show of hands. Okay, for those watching us virtually, I did not see any hand. But having said that, I think paying taxes is a necessity because of the infrastructure that we have around, the services that we demand of the government. The government does not have its own money, so we, you and I, have to facilitate the government. So without much ado, I think just to say appreciation for having us on board, and we look forward to a very interesting conversation this morning and into the afternoon. Thank you very much.
Thank you very much, Commissioner. And for those online also, and for those in the room, it's good to note that when she asked who enjoys paying taxes, even the Commissioner didn't raise her hand. That is a fact right there. Thank you so much for that, Commissioner. I think at this point in time, we'll call on our panelists as we discuss manufacturing and taxation. And you know, they usually say men lie, women lie, numbers don't. That is an adage right there. And it's an interesting case of numbers when you look at it right now. We have a sector that's contributing 18% of government revenue, but 7.2% of the GDP. What goes on there? Is it overtaxation? Could that be the issue? Is it a sector just overladen with challenges at its doorstep and can't really get it out of the tracks as it should? That's a conversation we'll have right here and explore the opportunities moving forward as well. So I'd like to call on stage those who will be part of that conversation. Coming on stage, Ms. Adija Nanyomo, partner at Ernst & Young. Welcome on stage, Adija. We also have Mr. Hilary Onami, Director, Public Policy and Research from ISPAC. Welcome on stage, Hilary. Many thanks. And the discussant for this particular conversation is Jobwan Johi. He's the head of policy and advocacy at the Kenya Association of Manufacturers. Karibuni sana. Of course, as they have the conversation, we want to hear from you as well, both here and those online. So once again, as you get your comments in, your observations, your questions, the hashtag is Tupatane Kasarani, and of course, hashtag Changamka Fest 2021. So as they get on stage, just a quick housekeeping and how this will work. We'll go down the line in terms of their speeches and what they feel as far as manufacturing and taxation is concerned. So we'll start from what would be my extreme left. We'll start with Ms. Adija, head on down to Hilary as well, and then our discussant, Jobwan Johi, will challenge some of those assumptions made, some of those cases put forth, probe those questions as well as we get into the conversation. So, gentlemen, lady, over to you.
Good afternoon, everyone. Allow me to take off my mask. Just wanted to confirm I'm observing the SOP protocols. Welcome, everyone, those online and those who are here present. We hope more are coming up. Like Jeff has said, we are looking at manufacturing and I'll mainly be talking about taxation. But just to look at the correlation between the sector and GDP and taxation, I think there are some numbers that are currently not adding up. When you look at the contribution of manufacturing to GDP, it is, manufacturing to government revenues, manufacturing is contributing 18% of government revenues. But then in terms of GDP, it's contributing less than half, 7.6%. I think if we are economists and we are looking at correlation, there is something not adding up. You should be paying tax in tandem with your revenues and your profits and all that. So is the question here we are to unpack is it being overtaxed? Is the tax system skewed towards, is this level of taxation impacting manufacturers more? Why are they paying more tax compared to the revenues that they are sending to the GDP that they are contributing to government? I wanted to talk about a few elements that have been a pain to manufacturers and maybe areas around which opportunities manufacturers should have to contribute to the economy, taxation-wise, and also growth in terms of trade, export, and all that. The first issue, which is burning, and I hope I'm allowed to talk about it here because it's a matter of court, it's minimum tax. The government introduced a minimum tax, and the main rationale for this was to tap into those that are having losses perpetually, not accounting losses, but for this purpose, tax losses. So when an entity has tax losses, it was envisaged that they would be paying a minimum tax of 1% of their gross turnover. And this has been a matter of controversy because we all know that manufacturers are businesses that go into business, and because of the heavy capital investments, they have a lot of losses. There are a lot of capital deductions that they get. So in terms of taxation, they end up having taxable losses. And the government is looking to taxing them so that they also contribute something. This is a matter of controversy, and a lot is happening around it. Currently, it has been put to a stop, but it's an issue that is going to be critical to manufacturers. So that is one issue that manufacturers are grappling with. The other one is around importation of industrial machinery and spare parts. We know manufacturers are so capital intensive. When they import their machinery and spare parts, they ideally, when they import them, there are a couple of taxes that are imposed on importation. They're supposed to be import duty, VAT, IDF, rural development levy, all those. From an import duty perspective, worldwide, capital goods are not supposed to pay duty. And I think that rationale makes sense and it's good. But when it comes to VAT recently, plant and machinery incur VAT. So imagine you've brought in a plant of $1 million, and even if you claim the 16% VAT, you have to first pay it. So that's something that is really heavy on them. Then on top of that, there is currently a 3.5% import declaration fee. That has moved from 2% to 2.5, now we are at 3.5%. That's something that is also really eating into the capital of manufacturers. It's something that needs to be looked into if we are to grow the economy. Rural development levy is the same. It came in at 1.5%, but when you bring in your machinery, being a capital intensive business, you again have to pay at 2%. So when you put all that together, probably it explains the 18% contribution to revenues as opposed to the growth in GDP. Then when it comes to other issues of a refund of VAT, we have seen a lot of value-added tax issues coming up, especially around refund. We had the issue around VAT automated assessments, where an assessment is sent to you and you're being told that you claimed this input tax, but actually the person who was supposed to pay it didn't pay it, so we are not paying it back to you, and vice versa. Or when you have that resolved and then you get what they call a credit adjustment voucher. This voucher is money to you, but it can't be refunded in cash, and yet you've already incurred it. These are some of the other issues that are affecting manufacturers. Ideally, manufacturers shouldn't have a lot of issues around VAT because they are registered, and VAT is a case of input and output. But then once the input becomes too much, it leads you into credits which do not serve the business, which badly needs working capital. I want to say one more before I hand over to Hilary, and maybe I can continue later. That's around the concept of withholding VAT. Again, this has become a pain, and we all understand where the policy came from. We have been pushing government to broaden the tax base. And it was a good idea that for us to broaden the tax base, we need to withhold VAT from everyone so that even those that are not registered can be captured as they supply goods. This is a good initiative. But when it comes to those that are already complying and they already have credits, then it just increases the level of credits that those entities have. And this has also seen some capital being tied up within this. The current rate, before it was 6% when we started off, and we thank the government, it pushed it down to 2%. But even with the 2%, there's still a lot of credits that are tying up capital that needs to be pushed down. So there's also a debate around there. Should it go to 1%? Should some of these businesses be exempted? All these are issues that manufacturers are facing, and they are being debated and they are being looked into to see that how best can they better contribute to the economy, the growth of the economy. I have many more to discuss, but allow me to hand over to Hilary to also say something. Thank you.
Thank you so much, Adija, and it becomes a challenge speaking after you've outlined the issues very articulately. Just a few things, and as the Commissioner was speaking, you know, it brought to the fore that Kenya's revenue portfolio is largely driven by taxation. And, you know, the entire scope of tax, income tax, excise, VAT, and custom to the end. And as she rightly put, it's through this that government then finances the infrastructure, gives the services that the manufacturers and the rest of the citizens consume. But a lot has been a concern about the entire taxation structure, the predictability of the taxes as they're levied, that are a bit uncertain to manufacturers. And there has been a call for, you know, setting up a tax policy framework to guide the way taxes are introduced, levied, and the impact to have a very predictable environment for manufacturers to operate in. There has also been the concern that you know, 68% of the profits of the manufacturers are eaten by tax. And then, as Adija, you're asking, is it a question of overtaxation, or is it a question of because essentially manufacturing should be a critical contributor towards growth of the country and the GDP per se. But we are not seeing that consistently over years. We have the target of 15% over the medium term to achieve the Big Four agenda, but we are struggling to meet half of that, half of that growth. Looking at Vision 2030, we are pillared on manufacturing as a critical contributor towards attainment of Vision 2030. Yet it's just 10 years into 2030, and yet we have not attained the dreams that we had earlier. There's also been a question about, you know, as the taxes, rather tax policies or tax legislative being misused to some extent. I think manufacturers have been crying that if you check on the excise duty, the inflation adjustments that happened just a few months ago, manufacturers have been crying that, you know, we've been through a very difficult period, and then you impose a 4% or 5% increment to on excise levies, increasing the cost of production, so to speak. So there's a bit of mismatch of policy and, you know, and the policy goals that the government has. In one hand, we want manufacturers to be a critical contributor and to enhance growth. And on the other hand, I think there are these some sort of non-tariff barriers, or rather non-tariff barriers and inhibitors to growth of manufacturers. So in essence, I think when you're looking about taxation and manufacturing, those are some of the critical questions that we need to ask ourselves as a country on what's the best way forward, that policies should be speaking to things on the ground, so that we have a country that is focused to a critical goal. Thank you.
Thank you so much. Myself, I'm a discussant, so I'm supposed to react to the points that Hadija and Hillary have raised. And indeed, I want to resonate with their sentiments that there is no direct correlation as far as the manufacturing contribution to the GDP is concerned, the revenue allocation, the revenue contribution, and also the budget allocation by the government. Manufacturing falls within what is called Government Economic and Commercial Agency, together with tourism and various other sectors. And you'll see that the allocation to GECA is about 1%. But you'll find that these are the revenue contributors to the economy, and to this case to our national treasury. So you find again, as far as the manufacturing sector contribution to the GDP has been sliding, despite the dedication that has been there in the Big Four agenda, moving to industrialization policy of 2012, Kenya Industrial Transformation Program of 2015, Vision 2030 of 2007-2008. All these aiming at how the manufacturing sector can get to 15% GDP contribution. But we have seen a slide for the last 4 or 5 years, from 9.3 to the current 7.2. So I tend to resonate with the sentiments that have been raised by my fellow panelists. And from where I sit, I believe there's some things that have made this policy disconnect to be. One is, in manufacturing, you find that there is ease of collection of taxes. So the government has concentrated on tax rates to be increased for the manufacturers. That's why we find that the pie of the profit, the larger pie of the profit, is going to the government. At the same time, you find that, like what I've said, that there's ease of collection of those taxes. At the same time, you find when we get now to the government allocation, when we are doing the budgeting, it's a bit wanting because of an overstretched budget. We have various sectors that are calling for this allocation. So what I would call for is a serious dedication coming from the part of the government, so that we see heavy allocation going to the private, going to the manufacturing. At the same time, you realize that it will be directly correlated as far as the revenue contribution is concerned. The other thing that we need to look into is the predictability, and this has been talked about, predictability of the policies that we are coming up with as a country. When we talk of investment deduction allowance being varied from 150% in rural counties, 100% in Nairobi, Kisumu, Mombasa, and now it's staggered starting from 50%. It has an effect on the investment drive. And again, it has an effect on manufacturing and taxation, because without investment, there will be no manufacturing, and if there's no manufacturing, there will be no increment on the revenues that are generated. Something else, if you look at from the custom perspective, is when we're talking about the common external tariff. When we are negotiating this, somewhere we've been stuck as a country at that %, yet our regional peers, United Republic of Tanzania, Uganda, they are at that 5% when we are doing the review of the common external tariff. Our interests, and we have seen this coming for the last 2 weeks, 3 weeks from the government, is that can we join our peers at that 5%, so that when we have a common external tariff that is protective of the industries that we have grown within the country, in steel sector, in agro-processing, then it's in those industries that we'll see some growth happening, and subsequently, out of that growth, we'll see revenue generation, job creation, and taxation increase out of these sectors. So we are happy that the government has joined the wagon at that 5%, but it is a question of asking, can we sustain our call of having the EACCT review sustained at that 5%? Something else is about fairness also. We have seen, like now in the Tax Law Amendment Act of 2020, talk of the Finance Act of 2020 and the 2021. We have seen some excess duties that are coming up. For instance, on plastic, 10%. It has been a pain on the manufacturers, because you find that those who are manufacturing the plastic packaging currently are the ones who are supposed to pay this 10%. But if you bring a product from outside the country and it is packaged in plastic, that plastic will not pay the 10%. So far, there's no fairness as far as that is concerned. Or even when we're talking about the minimum tax that Hadija has talked about, it was a bit unfair to get even those who are compliant today and they are paying taxes to get to a higher bar because of the minimum tax. At least the High Court the courts have declared it unconstitutional. It's now at the higher court. We are waiting for the determination at that higher court. But you find that such a tax also is disadvantaging some manufacturers against other players. There are various other points that I could raise, but let me leave this chance again to the panelists before I jump in again.
Thank you, Job. I think this first round has been more of a, for lack of a better word, lamenting, but I think there are also other good things or opportunities we need to look about. So before I lament again, I want to talk about 2 opportunities that we as manufacturers have that we can take up from a tax perspective and see growth in our sectors or in our businesses. The first one is currently the Kenya Revenue Authority is running a voluntary tax disclosure program. This is something that ensures that, well, first of all, we know that our tax system is complex, so you could have inherently, knowingly or unknowingly, not paid the correct tax, and the Revenue Authority has come up and said, yes, this is the time, come up, try to check yourself, self-assess, look at areas where you left out or you're exposed. Come and declare to us that you have this tax, you didn't pay in year ABCD, and then we shall waive all the interest. This is a saving, so to say, for those of us who have been given assessments with heavy penalties and interests. We know what it means to just pay the principal. So that program is running, and it's just to tell the teams and the manufacturers here and everyone else that this is an opportunity for us to check ourselves. The application process is on, the portal is on, the system is up and running. There's a form that one has to fill, then you put your facts, and then you pay the principal tax. So what will be done is that there will be a waiver of penalties. It is going to run for 3 years. In the first year, which ends in December, if you declare, 100% of the interest will be waived. If you declare in the second year, 50%, and the third year it will be 25%. So the early bird catches the worm. It's good. This is an opportunity for us. There are few exceptions. If you're undergoing an audit currently, you are not eligible to participate in this. If you have an intention to be audited, you're not eligible, but on ground we have seen a lot of discretion. The taxman is trying to work with taxpayers to ensure that this is a success. So even if that is the case, you can engage the team members, and if there is some level of voluntary compliance, probably there are issues you can look at. The other opportunity for us as manufacturers is the ongoing Africa Continental Free Trade Area. There's a lot of opportunities for manufacturers there. It's one of the core issues. We, as Kenya and as EAC, we've already ratified. We are negotiating the origin rules. We are negotiating the common external tariff. And if all the benefits are to be achieved, I think there's going to be that long-awaited growth. If Kenya is supposed to be an export-led growth country, then this is the only way to improve our intra-Africa trade and ensure that we trade with our parties, with other parties within Africa, and speak as one to the whole world. So that opportunity is also there. There's lots of involvement with the Revenue Authority, and that's why I've brought it in a tax discussion. Customs is heavily involved. There will be trade liberalization, meaning that if you import goods from countries where you have not been benefiting from, you now can. Countries like South Africa, countries like Nigeria, Zimbabwe. Zimbabwe is in COMESA. There's been some bit of benefit there. But specifically Nigeria, Mali, Niger, Morocco, all those, it's going to be better trade between those countries, because if they liberalize trade, we are going to see goods coming from South Africa hitting soil at lower or reduced rates of duty and eventually at 0%. So that's those are the two opportunities I can think of for now before I go into other sticky areas again. So over to you, Hilary. Thank you.
Thank you so much. The same trajectory maybe also to, I think the taxman has been pushing us too much the last few quarters. They were trying to meet their targets. Now they already met. So, and the good thing is they are also very accessible and open to discussion. And I think a lot of also have been going on in trying to simplify and make sure that the processes are efficient and easy, in line of automation from high tax to integrated tax management system to the custom, and quite a number of good processes are being put in place to facilitate efficient tax payment by the taxpayers. And I believe some of you were recognized and commended for being distinguished taxpayers. So some very good progress that the taxpayer has been putting in place to facilitate manufacturers and indeed all Kenyans to efficiently pay the taxes. But that said, there remains quite a number of policy gaps that needs to be, streamlined between the county governments and the national government. I think manufacturers have been facing a lot of, varied taxes across the countries, especially when they are doing distribution of their manufactured goods within the country. There has been need to have a collaborative engagement with the county governments to make sure that we speak as one country, so that whatever goods, as the Constitution provides, the manufacturers are able to transport goods across board. So to me, I think that there's some, we're making progress, albeit slowly, but we'll get there. This session has been for positives. Job, maybe you can also outline yours.
You can hear me? The discussant most of the time takes the direction that the pilot takes. Only in few exemptions that no correlation on the thinking. So I have also to notice that the VAT refunds have been coming through very fast. In fact, in our Tax and Trade Committee within CAM, this is one of our priorities that we have been running with for the last 2-3 years. But the chair of the committee has said, drop this for now. At least we have seen this coming through. Hongera to Kenya Revenue Authority and also to the National Treasury for expediting the VAT refunds. The general VAT refunds is only exemptions of like what Hadija was talking about, withholding VAT in many other areas that we need to improve on. Something else is, like at the moment we are doing the budget process. We are doing the budget proposals for EAC and national proposals. For the national proposals already we have completed. We should be facing the National Treasury on 29th or 30th, so that we can justify the proposals that were put in therein. But the positive I wanted to note is that 80% of the budget proposals that we present to National Treasury and then to the EAC, 80% they are adopted and they are gazetted for our manufacturers in terms of stays of application, in terms of duty remission scheme and many other forms. It's only at the domestic level proposals that you find it's a bit wanting. And if we can reason, like now we are organizing a retreat to sit down with the National Budget Committee, the one that sits at the National Treasury, whereby we can go and sit down together and understand how CAM develop its budget proposals for the national level and see whether we can see more adoption of these budget proposals and getting into the Finance Act, then to assent of the same. So domestic taxes, we need some improvement. Something else is on the custom union. I go back to the custom union again and the common market. You realize that we have tried to live to the EAC treaty as much as possible. But somehow, as a country, we feel like we are big brothers to the rest in the region. And you find that some countries that have stays of application, they have duty remission scheme. Probably it is not a regional-wide duty remission scheme. Somehow we are allowing them to offload their goods preferentially in the country, whereas they're supposed to be paying that 25% or that probably that state duty. So that's an area that we need to improve on, so that we have fairness across EAC as they're trying to implement the custom union and the common market. But I have to say that as far as the custom union and common market is concerned, we are at 80% implementation. We are doing okay. It's one of those areas whereby we are acting as big brothers that we need to improve on. Back to Jeff.
Probably I could jump in there as well. We have 10 minutes even as we get through this conversation before we have the next one on regional and international trade development coming in. So, of course, you can get those questions ready. But let's also probe, because we've looked at it from Lamentations, as Hadija said, looked at the glass half full in this second round. But Hadija, if you may, in terms of your perspective as far as sharing this tax burden is concerned, how do you do that, like, across all the economic sectors, from agriculture to manufacturing to services? How do we share this burden that we all don't want to carry, but unfortunately we have to? How do you do that?
I think for me, when I look at principles of taxation, if we go back to the books, to economics and all that, they are very, very clear. And what I'm seeing in a bid to collect more revenue and all that, sometimes from a practical perspective, this is distorted. So you find that economic theory determines that if you are going to introduce excise duty on plastic containers, for instance, what are the things you look at that may not distort? Have you looked at the whole value chain? If I'm going to produce paint, for instance, and the paint is not excisable, I'm going to pack it in a plastic container, and that container is excisable. What impact is that going to have overall? So when we are setting up the taxes, which sector is this in? How many sectors are involved in this? Because the principle of taxation overall is very clear, that you pay based on your capabilities. So that is the clear cut. But when we are setting the rules, the taxes, implementing, removing others, adding others, do we take that into consideration? So when we see that distortion and what we have called the non-correlation between how much manufacturing pays in taxes and how much it contributes to the GDP, I think there's some work we need to do around looking at things holistically. When you're trying to levy a duty, say, or in VAT or income tax, can you measure what impact it will have on the others? Because it's the same company, me, that is going to pay the VAT. I'm the same company going to pay the excise duty, and I'm the same person going to pay the income tax. So if my income tax rate goes up, or if I pay more income tax, there's some eventual effects that are going to spill over to the other taxes. So you will not see me paying the same amount of taxes. There's some spillover effects. So for me, my feel is that even when we come up with the national tax policy, these are things we need to really look into. We need to bring pure economists together with the practical people to ensure that this national tax policy is watertight and it guides on how we set the tax systems, how we put things in line to ensure that we deliver and have fairness. We have the canons of a good tax system. There's supposed to be fairness. If manufacturers feel they are paying more than the service industry, how do we balance that? How do we ensure there's fairness? So for me, it takes me back to what I expect to see in the national tax policy. I expect to see how often should taxes change. I expect things like how much powers do the tax collectors have? What is the role of the policymaker? What is the role of the administrator? How long should the refund process take? Those are things that will clearly bring around this, this fairness, the predictability and all. Thank you.
Thank you for that. Of course, like you said, a good mix of pure economists and also those with practical skills to make sure it moves forward. I think in social media terms, what she's saying, that bridging of the gap is when they say, kwa ground vitu ni different. Because the economist thinks of it a certain way, but when you actually practically apply it, it probably has a bit of a disconnect. Thanks for that, Adija. Hillary, we're approaching a very big campaign season as we get into the elections, and we can already hear talk of most leaders talking about how they'll expand the tax base, put more into the tax bracket. When you think about it in practical terms, how can we actually broaden this tax base? What strategies can government deploy to actually do what the politicians promise to do? How do we get there?
Well, thank you so much. And that has been a critical policy discussion for a very long time. And the way we're looking at it is we have currently about 6 million taxpayers, Kenyans with PIN, with carry PIN. And all of that, I think about just half of it or 30% contribute to the taxes. And the rest filing nil returns. Yeah? So you can see from a population of about 50 million, only 6 million actively contributing. Then there's a huge gap of equity there that we have a lot of Kenyans that are not directly paying. And a few strategies that we've been proposing. One is to have a single identifier that, identify all of us. There's a lot of, I think, quite a number of data sets that are not speaking to each other. You have your ID here, you have your birth certificate the other, you have your PIN the other side, you have your bank account the other side, and all these are not speaking to each other. So whenever you're buying land, whenever you're transacting, and we think that having that single identifier will enable one, even government policies in terms of subsidies and others reach the intended targets, and as well as recoup from the, and we say it's about 96% of connectivity in mobile connectivity in the country. So if 96% of us as Kenyans are on mobile, then I think government can trace its way back for the sake of taxation and improving service delivery to it. So if retired Right Honorable Odinga is going to give every youth 6,000, So I think having that identifier and tracing these people will be a critical add to the base. But also adopting technology in terms of looking at blockchain, for instance, having the data sets, the immigration speak to the land ministry and speak to KRA. I think if we adopt technology, it will even easier the issue about VAT for manufacturers and unlike. So it's not one fit-it-all kind of approach, but quite a number of things that can be done to enhance the base and make sure that, and the other on the softer end, just making sure that Kenyans feel that their taxes are utilized efficiently and effectively. That will have an enabling, a trust environment that will make sure that, if I'm paying tax, I don't see it being misused by the politicians or the government. It's not being taken 2 billion of it every day, wasted to corruption. Some of those bits needs to be tightened up to make sure that Kenyans own up. Tunalipa ushuru, tunajitegemea, and we see the end product of our taxes. Thank you.
Thanks for that, Hillary. I don't know why when you're talking about those people filing nil returns, you really gave me a dead look. Because the commissioner is here, let me just have it on record that I am not filing nil returns. I am paying my taxes as I should, just for the record. Of course, we're bringing this conversation to a close at this point. Of course, coming up next, we'll be talking about regional and international trade. But before we do that, because we looked at both sides of the coin, I want to just wind up with Hadija on this. Because when you look at the taxation regime right now and its implication on manufacturing as it stands, what's your general assessment now as we come into the end of this calendar year, as we get into an election year? What's your assessment of where it stands and how we can do better as we move forward?
I think for me it still goes back to going back to the drawing board. What I feel is, personally, I believe in solving difficult problems using very simple techniques, because at times you go to a doctor when you can't breathe, and the doctor says, you're dehydrated, you just need water. They pick water from the dispenser, give you, and you go home, but you are brought in on drip, very sick. So for me, at times, I feel the issues are not that huge, because when you talk to people out there, no one has a problem with paying tax. It's just that sometimes it's complex, the rates are a bit prohibitive, and at times we know the Revenue Authority, the policymakers and administrators, they cannot look out for all the 17 million people with PINs, or the 12 million or the 10 million. Simple things like having partnerships. Who speaks better to the Juakali people? When you look at associations that are there, are we quoting them as tax collectors, as tax policy makers, to hear what they say and to ensure that we get close to them and get those people who understand their language to speak to them so that we bring them into the tax net? It's just a matter of another simple thing like simplifying procedures. If I'm a manufacturer with a turnover of 5 billion, imagine me as that manufacturer, I have the same tax regime as someone of 100 million, 50 million. I have the same tax regime. VAT, the threshold is 5 million. So a person of 5 million is supposed to read a VAT Act as technical as it is and implement it, have the ETRs, ESDs and all that. Now we are going into electronic invoicing together with the other one who has 10 billion. So simple things like simplifying, endearing yourself to those people we want to get in the net. Because for me, my view is we focus so much on the big ones that are already there, and soon we are milking a cow that doesn't have milk anymore. So it's high time that we simplified, we endeared, we focused more on that small trader, that informal person who can get into the net and give us more revenue. I think that's all I can talk about. Thank you.
Okay, thank you so much for that. And I think also we'll bring this particular conversation to a close at this particular point. Ms. Hadija Nanyomo, partner Ernst & Young, thank you so much for your contribution this morning. As we get into the afternoon, Mr. Hilary Onami as well, Director, Public Policy and Research at ISPAC, and of course, our discussant, Job Wanjohi, who's also Head of Policy, Advocacy and Research at the Kenya Association of Manufacturers. Many thanks for taking us through that conversation on manufacturing and taxation. A round of applause for them, tafadhali. Asante sana for that. And of course, as we get ready for our next panel discussion on regional and international trade development, as we get ready, we'll have a short intermission. But before that, closing remarks from... As we get the next panel ready, we'll have some closing remarks from this particular address of manufacturing and taxation, because we have the commissioner in the room as well. To Rispa, over to you for closing remarks before we move on from that particular subject. Asante.
Thank you very much, everybody. I think when we started again, for the record, who likes to pay tax? Again, thank you. Oh, there is. Okay, probably after the panel discussion, then somehow I have a few people in my corner. But let me start by appreciating the panel for your very, very good and brave and I think honest remarks. As it is, as we said, you know, sometimes as a tax man or tax woman in this case, because somehow they keep referring to the tax man, I think it is tax woman standing here, but anyway, we usually start from a position of a handicap, and I'm not talking about golf, yeah, for the golfers, not exactly one. You know, I always say as a tax person, you're damned if you do, you're damned if you don't. So whether you collect, you're hammered. If you don't, there is still a hammer. So, but someone has to do that noble job, and I think it's our civic duty to do that. Just a few comments. I mean, I'm not going to comment about the minimum tax. As we said, it's sub judice, and that has been discussed by the panel. But I thought it wise to just say a few things, and especially at the back of the comments given by the panel on what KRA is doing in light of trying to make tax payment simpler and compliance burden easier. Looking at 8th corporate plan, and I'm hoping a number of you have taken time to just look at that 8th corporate plan. There are certain things that we are focusing on in the next 3 years, beginning this year. One being the tax-based expansion. We've talked about tax-based expansion quite a bit, and the conversation started from a correlation between GDP and contribution in terms of revenue and contribution to GDP. And the question then remains, is there a group that is targeted more than the other? This conversation about TB, tax-based expansion, has been on for long. We are looking at different things, whether you talk about digital economy, which you're aware of now, taxation of the informal sector. The question remains, it's not the what, it's the how to get to them. And largely, data-driven compliance. Why we've gone into data-driven compliance is, what does the data that we have on our taxpayers tell us about our taxpayers? Is someone carrying a higher burden than the other? So even as we're expanding this bracket, we're saying, let more people come into the bracket so that then we can ease this burden on those of you already compliant and paying taxes. So for us, sometimes it's also a rallying call, even through CAM, that help us sometimes, like I think the panel said, we don't have enough eyes to be on the ground, but if you feel there's someone with unfair trade practices, there are very many ways of bringing that forth so that then we can all have a level playing field. Secondly, we've talked about tax simplification. Historically, and I think you'll agree with me, for those who've been at it for long, there was once a time before iTax when all of us would make sure that you passed those times tower doors before 5 p.m. Because if it meant running, if it meant taking a boda, whatever it was, but you make sure you cross those doors before 5 p.m. That was pre-iTax. Now with iTax, at the comfort of your home, your office, even sometimes in your car or in a matatu, wherever you are, you can actually pay your taxes. KRA has gone a step further, that you don't need a computer to pay your taxes. We have something we call the M-Service app, for those who don't have it. you can actually file your returns. And we are improving that so that everything and anything that can be done on iTax then can be done on that app. And last but not least, we are moving towards technology-driven compliance. The whole idea here is that to work together to improve compliance and make it easier for you to comply. Then, that way, then, it will not be an issue of catch me if you can. It will be you coming to the table, you've paid your fair bit, and even as we are asking the questions, you have your information ready, and it is all supported by technology. So just a few things, and I do agree with a bit of the tax policy. Indeed, if you look at the tenets of taxation, we're talking simplification, certainty, transparency, fairness, consistency, all these. And with all these, then it makes it easier, be it a large manufacturer, be it, even as we're talking of Mama Mboga, all of us are able to understand what it is that is expected of us. Tax policy, work in progress. We do hope, and we know that we've been cooperating very well with CAM. We look forward to contribution in this as we move towards that area. But that said, there are certain things, and I think when these engagements will be happening, it will be clearer what then can go into the tax policy and what cannot. Matters procedural. Procedural matters on tax, there's a particular act, the Tax Procedures Act, that talks about procedures. What happens when you don't do this? This is what you're expected to pay by this day. This is what you're supposed to file by this day. When you don't do that, what are the consequences? What fallback do you have? If KRA has come to you, you're not happy with the outcome of the engagement, what options are available to you? As it is, we always call for people to come to the table without necessarily going to the Tax Appeals Tribunal or to the courtroom. We have an alternative dispute resolution option. Please come to the table, let us engage. And I think as I wind up, we look forward to further engagements, stakeholder engagements, talking from the top. And sometimes perhaps the top manufacturers, you'd have access to the, the audit firms, the tax advisors, whereas at the bottom level, not the same case. But we are at hand to engage at all levels to make sure that then we don't go back to the catch me if you can, or, when the mice is away, the cat is away, the mice shall play. And we look forward to better engagements. But having said that, thank you very much for paying your taxes and honoring your civic duty. Thank you very much.
Another round of applause for the tax woman, please. We underscore that. Many thanks indeed for that. And also a round of applause for our panel for going through that particular discussion and calling it out as it is. Many thanks, gentlemen. Many thanks, lady, as well. You can have your seats. We're going to take a short intermission at this point as we change and have panelists, the next panelists come on stage. Of course, it's all about regional and international trade development. That's a conversation we'll be having right here after dealing with the taxation issue. How do you develop that trade? We'll be having that in just a bit. The moderator to go through that will be Mike Washira. He'll be taking over from there. So just short intermission. We get the next panel on stage, and the conversation continues right here at Kasarani. And for those who are following online as well, don't leave, by the way. You can send your questions in, your comments from the last conversation as well. The hashtag we're using is Tupatane Kasarani or Changamka Fest 2021. Short intermission, then we're back with the next conversation. Don't go too far.
It's our lunch break. Now, as I said, my name is Mike Washira. I'm taking over from Jeff Mote for the rest of the session today. And we are going into a very exciting conversation because we have just talked about the issue of taxation, which can be a very thorny issue. And we've been looking at what are the pros and cons, what are the opportunities that lie within the country, and some of the challenges which we have had a discussion about. But then when you look beyond the border, what opportunities are lying there for Kenyan manufacturers? We complain a lot about things happening in the country. There are opportunities which are out of the country and across our borders. And the establishment of the African Continental Free Trade Agreement, which established the African Continental Free Trade Area, is one of those opportunities that Kenyan manufacturers can take advantage of. But since the establishment in 2018 up until now, where have the opportunities been? Have we taken advantage of them? And what remains to be done? So to have this conversation, I'd like to invite the following distinguished persons. I'd like to invite Dr. Margaret Chemengich, who is a trade consultant with the Kenya Association of Manufacturers. Dr. if you're here, please make your way to the podium. Asante sana. And she will be presenting a study that has been carried out looking at exactly what those opportunities are in the African Continental Free Trade Area, what opportunities lie for Kenyan manufacturers beyond our borders as a result of that mechanism. And the discussants for this conversation shall be Oliver Konje, who's the Director, External Trade at the State Department of Trade, and George Dinda, who is an expert on the Africa Free Continental Trade Agreement from the Ministry of Industrialization, Trade, and Enterprise Development. Gentlemen, please make your way to the stage. By the way, tunaweza wapigia makofi as they go up. That is how I'll know who has earned their lunch this afternoon. So, like I said, very exciting conversation. There are opportunities that lie outside our borders. What does this free continental trade area propose for Kenyan manufacturers? Of course, this being the biggest trade area established since the World Trade Organization as a free trade area. So very exciting opportunities there. And I'll invite Dr. Chemengich then to make her presentation. And then we can have a conversation and reactions around that. I think the microphone is on, Dr. Yes, it is.
On now.
Yes.
Thank you. Perhaps I'll have the slide at my back.
Okay. Yes, that's there.
That's the one here.
Right. So, karibu daktari.
Thank you so much. We've already been introduced, the studies, the implications of the African Continental Free Trade Area on Kenya's manufactured products and the impact in totality on Kenya's trade. What are the issues? Where are the opportunities? What are the risks? And how shall we navigate out of the risks and take full advantage of the opportunities? So the objective of the study is to say, since the African Continental Free Trade Area is already in place, how can now CAM prepare itself to take advantage of these opportunities? And the KRA has just been here. What role can they also play to make sure that CAM membership can expand? Then the tax base can equally expand. And we are going to look at the agricultural value chains, because that is where the manufacturing is, and other manufacturers that are not agriculture related, the non-agricultural products. And to go through this, we are going to say, let's estimate what are the trade potentials for the manufactured products. Because really going in now, it is already signed. So that is fait accompli. What is it that we need to do and move forward? How is our competitiveness? If there are challenges therein, we look at it. And how will the rules of origin affect trading at the continental level? Because it is easier to reduce the tariff, remove the tariff. But the gatekeeper to trading is the rules of origin. And the facilitator, the trade facilitating arrangements. Because you can't just sit here, manufacture, and the goods will fly out on their own. They will require infrastructure. They will require those customs officers who have been here because they have to issue certain paperwork. It will require these policymakers to make sure that they have a functional, business-friendly policy mechanism to allow and facilitate CAM membership to expand manufacturing. In fact, it takes a lot of, calming down, because our employer at the end of the day, the person who keeps this running all the time, is the private sector who take the risk to invest. Then we can tax. So I was listening in on KRA, and they were saying now they are ready to talk. Because you don't go and close a business. Once you close it, then there is no tax revenue anymore. So those are the bits where we now say, how can we leverage our partnership, have the symbiosis, and we look at quite a number of these areas. And we are saying, as we look at this regional and the international trade, Kenya is a global member to the WTO among all the others. At the regional level, we already signed on to EAC, COMESA, IGAD, SENSAD. We have expanded because of the challenges we had in the multiple membership under the under EAC, with members in COMESA and others in SADC. The TFTA was born. Then the fact that when we did that implementation, we realized manufacturers are actually being sold in Africa. What we are selling to Europe are the agricultural products. So we finally established that if we have to sell more manufacturers, then let's cover the whole continent study. And we are saying, we are going to ask ourselves, how have we been trading prior to the CFTA? Now, supposing we liberalize, how are we going to trade? And let's focus on chapter 1 to 14, the agro-processing, because that is where we are doing a lot of business. But that is not to say we should live there. We actually need to move out of there and diversify. So we used qualitative and quantitative approaches. And we did quite a bit of analysis through trade flow analysis to see trade direction. And we did also simulations to say we've finally agreed on 83.3% of liberalization at the continental level. But we are aiming at 90. And then we say, supposing we opened the whole of it, what are the implications? This is what CAM was looking at, so that they can now do policy advocacy to see whether we should engage more with the government to see how we can at least facilitate more trade, create employment opportunities, create taxation options so that the government has more resources to give services to the private sector to become competitive. Then we also looked at indicators, because you can't just hope that you will do business. Before you make that decision, you say, what is it, where are the potentials, how can we take this forward. Then we also said, let's benchmark best practice. Others have been there. We are not the first ones. So we have to do some benchmarking. And those are the bits we looked into as we were doing the analysis to see where are the opportunities and where are the risks. How do we navigate out of the risks? So what were some of the key findings? Now, interestingly, the key findings is that Kenya trades globally. Actually, we trade more globally. We sell more at the global level. But even within the continent, we are actually in all the 8 regs. So there is already an opportunity. It is markets we know. So we also say, in addition to trading, there is an element of informal trade. And these are the SMEs and the individuals. And we are saying, if they are already walking around and they are contributing 40% of what we record in formal books, and such that now what we record, it is half of what is being traded. And if KRA had sat on longer, there is an opportunity for taxation, the informal trade. Because these people are already passing through various borders. Under the EAC, we tell them if your sales are below a certain amount, really you have a simplified rules of origin certificate, you can carry your goods. So all they need to do is to tap into that database and see what they can do. So we are saying we are in all these arrangements, but the bulk of our trade is exported, 62% is export. So we are left with the 38 to see where, and we are taking that one around in the continent. And we thought, if the figures were too difficult, visual, you can see that we do a lot of business, export to the COMESA, EAC. We've been picking up in the SADC because some of the SADC members are COMESA members. We also import from COMESA, EAC, and the IGAD members are actually EAC members. So this is just to say we are in all these markets. But how much are we in those markets? And what is coming through is that really our trading partners are in the EAC. That is Uganda, Rwanda. We also have some DRC, but we import more from South Africa, so that's a deficit. So as we do the analysis and as we want to at least have a balanced trading arrangement, it is now we identify where it is negative to say what can we do more in those markets. And I'm sure as the president is down in South Africa, he has gone with the 397 southern trade deficit to see how we can bridge that. I do recall we had a problem with avocados. I don't know what it was else. It was negotiated, and finally that market was opened. So what is it that we want to open going forward? Then we said, okay, we've seen we are in business and we have markets where we are already trading. But to trade, you must be competitive. So how are we going to assess this competitiveness? Because we've already just established that we are selling agricultural products, tea, coffee, cut flowers, and low value added components of cigarettes, beverage, pharmaceuticals, and oils. And we are competitive in those products, but we said, okay, let's look at our global competitiveness index. And Kenya stands at 55. The rest of Africa is between 25 and 60. So we are competitive. in as far as that aspect is, that's a positive. We needed to be at 100. We can improve on this and get to 100. Then economic complex index. How complex is our economy? Because we've just seen it is tea, coffee, cut, flowers. Those are not complex. Because those are wholly obtaining. It is products you are getting from the market. You get some from the minerals underground. And all you do is pack them and sell them. The only area where there is some element of complexity is cigarettes, beverages, and pharmaceuticals. So we say, where are we in that area? And we are saying, we are still at the lowest end. We shall show you a diagram which can tell you where we are. And it is not us alone. We looked at the index. For the whole of Africa, we are all resource-based. The only ones who had a more complex economy was Tunisia and South Africa. So those are, again, markets where we say, unless you interact with them, you cannot improve your quality. So you don't start saying, we fear South Africa, we fear Egypt. Because if you fear, you are going to remain at the lower level. So where are the trade potentials? And we looked at the number of indicators. And we are saying there is complementarity. It is around 50%. It's actually slightly below 50%. But then we are trading in low value products, commodities, but the potential exists in the high value content. Because if we are only doing a trade of 15% in traditional trade, we have potential to increase it to 50, 60%, which other markets are doing. The European Union, the US, and the rest of them are doing far better. So we are saying 15% we've started. There is potential to improve. It is now how do we improve based on this. And the revealed comparative advantage, where is our strength? We are saying currently it is still in agriculture and agro-processing. But we can do a lot more. Because we are sending out all our tea, all our coffee in commodity form. And it is being brought back in a tea bag. Can't we do more of that tea bag and sell it globally? And we are saying, since the products we are trading in, because we export and import the same products, they are similar. So there is flexibility for us to do business. Do we have strong value chains? Still low. We are having value chain of the maize, the rice, wheat. These are, still commodities. Those ones are at the lower end. We need the one where you do value-added content. Because once you do that one, then it is going to give you more value. And this is the diagram I was telling you about. When you look at all our exports, they are resource-based. So we are dealing with the food, wood, leather, petroleum, rubber, and other resources. We've done a small bit on garments. The textile is still very far. We do a little bit of footwear, furniture, limited glassware, and the rest. Now, where the technology starts improving is in the medium-term technology. The motor vehicles we do, it is assembly. We are not manufacturing the whole of it. So all we are doing is getting nuts and fixing it. And perhaps do a bit of chairs here and there. We do a bit of chemicals, metal products. So this and the high technology, this is where we should be heading. So let's move to the third level, which is medium technology and the high technology. Even the pharmaceuticals, we are doing aspirin and these other small areas. When the COVID came, we couldn't cope. So we were waiting for others to do the research. and come back to those areas. And these are areas now where we should be saying, how can we move there? And you don't have to do a vertical. All you need to do is do a small component, the fragmented production system. This is where globalization has brought us. This is where technology has landed us. So gone are the days in the olden times when we would ensure that you start from the base all the way to the final product, and then you even deliver to the consumer. Now, these duties are spread and shared out among many players. So we said that is where we are. So we know where we are. We've already signed on the CFTA. What are the potential impacts? Where are the risks? Where are the opportunities? How do we navigate out of the risks? We looked at a number of scenarios, and we said, let's look at the impact of the Kenyan economy with across the different regs. And we are now saying, really, when you look at the different economies, you will see that trade is, because you remember we said that our trade was very minimal. The products are still very minimal. And so the trade is, it won't change substantially because it is the same products you have. So our challenge is in the products. Even if you liberalize up to 100, we still have limited opportunities. And we now said, let's look which countries are we going to trade with when you liberalize to 100%. When we are saying we are trading with South Africa, actually South Africa is having a field day in our market. Because you saw their products are more complex. So those are the ones who will take over our markets. So where we are increasing the opportunities is where we now have the negatives, because there we are at least selling a little bit more. So you can see that there are opportunities both in ESC and in the SADC region. The West Africa is still a difficult market. Other than the tea we take to the north, the West Africa might be difficult to the extent that we don't have infrastructure. It is the connectivity issue, which is going to challenge us taking full advantage of that market. So, which are the areas where we think we could take advantage of? We are saying the vehicles, the foodstuffs, base metals, plastics, rubber, textiles, and you will both increase and increase. However, to the extent that our prices are uncompetitive, we shall be displaced in our local markets. So all you have to do now is to say that was a risk. How can we navigate out of that risk? So in essence, we are saying ESC is still our best bet and a COMESA, because that is where we are selling. Because when you are trying to assess these aspects, you see where do you sell. And then we are also selling agro-processing. But once you open, the agro-processing is one of those which is likely to be kicked out because our prices remain uncompetitive. So all we are now seeing is that competition is still our challenge. So going forward, let's focus on those areas, and as you do the negotiations, you see how best to look at this. And you would be saying what is those to be impacted negatively and positively. I don't know whether the others from the back can see it, but you can see that the products, there will be a two-way trade. In the same products, it might be you import a Mercedes from South Africa, you sell perhaps our Toyota vehicles into the other countries in the region. So trade is about things moving across. You don't close borders on others. Because if you close borders on the others, your borders will also be closed against your products. So if we are getting milk, eggs, and the rest, or sugar from the other countries in the EAC and the COMESA, we already know that we are a sugar deficit country. We are a maize deficit country. We are a wheat deficit country, food-wise. So what is it that we should be doing? Because will you as a manufacturer opt that the consumers of your products die of hunger because you want to sell your products into the market first before the competitor comes in? So trade is in a two-way. And you can see that we are exporting products which are similar to whatever we are importing. So which means our economies in the continent are similar. And we are doing only 15%. So where do these economies get the 85 from? And that is where we should be now targeting. We want to see how much of the 85 we can get into, and get into partnerships with the government to see what support do you need. Of course, you can't ask for subsidies all over the place. KRA was here. They have to provide the roads. They have to invest in education. They have to invest in health. They have to invest. Those are subsidies which you ride on as an investor. So you can see that at 83%, the trade is in agriculture. That is foodstuffs, vehicles, and a bit of textiles. At 100%, trade is still in foodstuffs. More trade now continues. The vehicles are still standing in the trade, and chemicals, now new products are beginning to come. So you can see opening the continent is going to give us opportunities. And we've got to look at how can we harness those opportunities. However, in the initial phases, because we already said we have a competition issue, our product complexity is low. So we are likely to be displaced in the domestic market, EAC market, and the COMESA market. And with that displacement, there'll be lost employment opportunities, there'll be lost output. And this is now where you say, how do we mitigate this? So the best thing is for you in the government to know in advance, these are areas where we are likely to lose. And since we are just at the beginning of the CFTA, what is it that we should do quickly to make sure that we secure those jobs, we secure the output? So that is where you now know exactly where the challenges are going to fall, and these are rural-based. For a number of them, this is where you get your tax revenue. So these are the bits where now you got to pay special attention and make sure that the policy arrangement and extended support to the private sector is in place so that we can remain engaged. Because once we get others exporting, it means, Kenya importing them, it means the demand is there. So we are not starting on a new product, but rather an existing product where demand is. So all you have to do is compete, improve efficiency. And the efficiency is not for the private sector to ask that, the tariffs on electricity, give it to us for free. Give us water for free and the rest of it. Because there is nothing for free. What is it that, how can you use whatever is available more efficiently so that you can also reach the market competitively? I think COVID taught us a lesson. When we were all locked in. But the private sector was selling. So how did you do it? You had to look for a way of making sure that you are out in the market. It was painful to lay off all the workers. So you made sure you looked for options. Government also stepped in and said, during this time we are going to handle it in a one way or the other to make sure that we help each other. Now that is where we already have an arrangement which we can leverage on to help each other save these jobs, save the output, and do more business. So it will be nothing new. We've already done it. So we are saying we shall get about 14% that, unfortunately, the 14% in the EAC are imports from the EAC countries into Kenya. We are not selling into the other countries. And this is because quite a number of their their pricing structure is a lot lower compared to the Kenyan products. So we are going to lose opportunities in agriculture and a bit of manufacturing where our prices are most hardest hit with 100% liberalization. Remember, we had protected the sensitive products. If we did 100% liberalization, then they are opened up. Even the story of sugar, where we are saying get a quota from Comesa and the rest of it won't be there. So what is it we should do? So the major challenges, which are supply, which are risks. And our challenge is there is none of you manufacturers who has a mountain of stockpiles, which means we are producing very small quantities. Now you have a whole continent of 1.3 or 2.3 billion people. And all you have is the small factory in the industrial area. What will that do? It wasn't even enough for EAC. And now you have the whole of Africa. So we've got to go for larger investments, have economies of scale. Then we don't only produce the Kimbo, the soap, and the small products that we've done all along. We now have to move and diversify. Because those other products, the food products, it is where we have the 15% intra-regional trade. So let's move out of the comfort zone. The other area which is still a challenge is the weak value chains. All our exports are mainly commodity-based, and if they are manufacturers, we are using all the technology which makes our products very expensive. Then we have an underdeveloped intermediate sector. And as perhaps we look into this, the intermediate sector is where the business is. If you look at our imports, we are importing more intermediate products as opposed to capital goods and the consumer goods. So that is where business is, intermediate. And if we want to do business, let's go into the intermediate. You don't even have to go all the way to the final product. You do the intermediate, and you'll be assured of business. The business environment has to be right. We still have policy conflicts, proliferation of NTBs. We have complicated rules of origin. We still have structural rigidities in our institutions. At times you get government institutions getting into each other's way. So that one says, this is supposed to be mine, this one's supposed, and you have those multiplicities. And at the end of the day, instead of the private sector being in the factory, he has to come to KRA to get documentation. He has to come to a different institution to get a compliance certificate and the rest of it. So I think with the digital platforms, we are beginning to make progress. Now, one of the issues which I highlighted right from the beginning is to say tariff liberalization is easy. You do it in a boardroom, and it is finished. You just sign the agreement. And you come to customs, and those new tariffs are populated all over the place. The elephant in the trade is the rules of origin, because that is the certificate for you to go and get actual entry. It was not the tariff. It is the rules of origin. How do we say that product really is yours? You might have smuggled it. When did it get the citizenship of your country or of your region? And so those are the areas where we are now saying, if it is wholly obtaining, at least the coffee, tea, horticulture, fish, they are wholly obtaining. There is the substantial processing. This is now where business is. If we are engaged in this, where you at least improve the quality, the value of the materials you are trading in by change of tariff, or how much value added content, how much you add onto imported inputs. And with that one, you can have the basic rules of origin. However, because we are now in a regional context, so again, you say, if I got my inputs, if I got, I've forgotten to be alerting you. So you will see that I will be alerting them. Okay? So that we now say, if the inputs are from within the same region, you add up. You don't say you must only get everything from Kenya. So that is where you do the accumulation. And how much can you have from outside, even Africa? Because now we have the opportunity to accumulate all the way within the continent. You can get now the West African cocoa and accumulate it with whatever processes you are doing, and you have the chocolate back in Kenya. So there are quite a number of those areas where we are now saying, let's look at these rules of origin, because that is the elephant in the room in as far as trade is concerned. We can easily handle the trade facilitation. Am I running out of time? Okay, let me. No, this is where business is. Yeah. And we compare the rules of origin. Unfortunately, our ESC rules of origin are more restrictive compared to the other regs. And when you look deep into it, it is in our agricultural products. Those are the ones we export. So again, we've got to look into those areas to make sure that we can at least harmonize, benchmark, because at this point in time, we are giving CFTA better prospects. So they are coming to displace us because their rules of origin are simpler and lower. Then the trade costs. We have the compliance costs at the border and the documentation. Those again, if we can go to the IT platform, at least the compliance costs will be easier. The border compliance costs, at least with what KRA was saying, it has improved. So we need to reduce on those areas. And we can see the maps. There are those where it is, agriculture is still very stiff to trading. The manufacturers are a lot easier. So what recommendations are we giving up? And we are saying, if we are going to trade in the continent,
Africa trade. Na tunachezea hapo at resource and low technology. Well, there are other spectrums that we could be operating in. Even if we were to liberalize to 100% and say we want to trade with South Africa, our goods and our pricing is not competitive. So what can we do about it? We now will take reactions from Oliver Konje and David Dinda. Karibu.
Thank you for giving us this chance to listen to the presenter and also the research that has been done. We appreciate what has gone into that research. I would like just to bring out some pertinent issue. One of them is the issue of the signing of the CFTA, Kenya being part of it, and we know that the trade was supposed to start January this year. But it is easy to sign an agreement and to operationalize it. Therefore, at this particular point, it may not be really fair for me to critique CFTA in a manner that is like something that will take a long time to manage. However, we will take you through what has been done this far in terms of CFTA, and I've come with my technical officer here who have been participating in the negotiations, where we are in terms of rules of origin and what we are doing on our side as Kenya and what we are doing on our side as EAC, as group of EAC partner states, so that you may probably appreciate what is happening so far. The other component is the issue of infrastructure development that has also been discussed at a certain level, which we will also give you the bit part of it. And the other aspect is also where we are in terms of digitalization within the African continent and the challenges that are there and what we can do to actually make it better. And that one also, you will be briefed on the same. I'll look at it also in terms of competitiveness. Right now, you know, even the other day, it was in the media that Kenya is losing and Tanzania and Uganda is gaining. Why are we losing, or why are the other countries gaining? It is the issue of competitiveness. And those are some of the things that private sector have raised, and they have come up with what we call pain areas that makes their products a bit uncompetitive. But that one, I know that CAM is aware of those pain areas, and they have shared with the government and the president, and those who are concerned are looking at that. We are also looking at how we can actually do what we call market segmentation. Where are we strong, in which areas or in which countries? I attended a meeting last week, and I think we were with Job, whereby it came out clearly that Egypt, Sudan, Uganda, and DRC Congo seems to give us a better edge in terms of market penetration. So if that is the case, then what are we doing in terms of penetrating those markets? We also look at the EAC market in general. How are we doing? Well, there are things that have happened that has made some of the EAC states to do better. And remember, it is during the COVID, whereby we needed probably more food, substance, and things like that. The products that came into Kenya were more of raw materials or food substance in nature. And that does not mean that Kenya is losing, because Kenya is strong in manufacturing sector and more so in agro-processing. So let us put our strength and let us put emphasis on how we can penetrate the market. We are also talking about Africa as a continent. We should look at the countries, and especially this research, which countries are actually measuring on importation of food. And we can give, for example, DRC Congo, Angola, in Nigeria, which is really importing a lot from Europe and other places. We should talk about Namibia. We should look at about Botswana, who is again another potential area, and so forth. But the country has tried as much as possible for us to negotiate at bilateral level to open markets. The consultant has mentioned about avocado going to South Africa. I was privileged to be one of the people who are involved in that negotiation. But sometimes the ball falls on our side. What do we need to do in order to do better? And some of these things that we are talking about in terms of adding value, sometimes it is not complex and it is not very complicated. Sometimes the issue of adding value is simply packaging. How do we package our products so that they enter a particular market? And you know, sometimes you look at our packaging, it leads to what we call wanting, because you take that product and you look at it, and you find it is below standard in terms of packaging. So yet the product inside is very good, but packaging may make it look like as if it is not a very good product. And I do not want to say much because of time, and I would like to give my colleague a chance, George, to tell you a bit where we are and how negotiations have been going on, and which kind of markets have we opened up, how we have negotiated for tariffs, and how will Kenya benefit from that, George?
Thank you so much, Bwana Director. Thank you so much, Dr. Jametich, for such a lovely and insightful presentation. My name is George Dinda from the State Department of Trade. Probably I want to make about 2 or 3 points on the ACFTA. The first one is, if you look at the map of Africa, you will see that we are so much fragmented, 55 member states. And these 55 member states are so small. We have about 16 or 17 landlocked countries within Africa. And so for any African country to grow economically, they wouldn't be able to do it alone.